Welcome to the deep dive. Today, we're taking a fresh look, maybe resetting the lens a bit, on how people view Dubai's huge real estate market. We're kind of shifting focus from those super tall, record-breaking buildings, the icons, and turning towards, well, the workhorses, the parts of the market that actually, get the job done. We've been digging into this really compelling analysis led by Swiss economist Dr. Pooyan Ghamari. He argues that the whole investment logic here is changing quite fundamentally, moving away from just chasing pure, maybe speculative luxury towards something more strategic, predictable mid-market performance.
That's exactly it. That's the mission for us today,
Mm-hmm.
unpacking that shift. And we're using a really specific case study to do it and this development called Reportage Village.
Mm-hmm.
Dr. Ghamari's work basically holds this up as a blueprint for a new kind of asset class. Think large-scale, really functional communities designed not for like magazine covers, but for solid long-term financial returns. We're looking at properties engineered to perform financially, demographically.
Right. So the big takeaway for you listening is getting your head around this difference. You've got assets built to impress the skyline stuff, the headlines, and then you've got assets built to perform. The ones generating steady rental income, fitting perfectly with where the city's actually heading in terms of growth. And I guess to understand those assets, we first need to grasp what's driving the demand, right?
Exactly. You have to look at the bigger picture. Dubai is entering this really profound structural growth phase.
Yeah.
This isn't just another boom-bust cycle, fueled by global money looking for a quick flip or a safe haven. This is different. It's defined by serious population growth and, importantly, real economic diversification.
Yeah.
Fundamentals are finally, maybe, taking the lead over just flashiness.
Okay, population growth. We hear that a lot, but sometimes it feels a bit abstract. Can you give us the hard numbers? What demographics are really underpinning this need for mid-market housing?
Yet the numbers are, frankly, staggering. And if you're investing long-term, you just can't ignore them. Dubai's population went past 3.65 million this year, the official projections. They're aiming for over 5.8 million by 2040. But here's the really critical bit. This boom isn't primarily driven by the super rich, the UHNWIs, buying those incredible beachfront places.
Ah, okay. So it's not the billionaires driving this specific demand. It's maybe the people they employ, the sort of engine room of the economy.
Precisely. It's the skilled professionals, that growing middle class. It's the entrepreneurs setting up shop, young families putting down roots, digital nomads. These are the people powering the knowledge economy, the service sectors, the whole administrative side of the city. And they need functional, well-designed places to live that are affordable and, crucially, well-connected. Their demand isn't speculative, it's structural, it's sustained. That's what makes these mid-market projects the absolute backbone of Dubai's next chapter.
That makes total sense. So if the professional middle class is the backbone, let's look at the supply. Dr. Ghamari says Reportage Village is like a textbook example of developers engineering supply for this exact demand. What does that blueprint actually look like? Scale, design, what are we talking about?
Well, it really comes down to a strategic view on scale. Reportage Village isn't just a few towers. It's conceived as a whole self-contained community. The emphasis is all on utility, livability, value for money. We're talking thousands of units, mostly townhouses and low-rise apartments. It's built for, let's say, manufacturing efficiency and to appeal directly to that family and professional demographic.
So the design itself is driven more by cost effectiveness and mass appeal rather than, say, unique architectural statements.
Functionality is definitely key, but the location strategy is just as vital. It's placed in a really important suburban growth corridor, so it's near major transport routes, near commercial areas. But crucially, it's away from the really intense congestion you might find downtown. The analysis calls it connectivity without congestion. And for busy professionals, that's a huge selling point, right? Minimizing commute time.
Yeah, I can absolutely see why that balance is critical for keeping tenants happy long term. And what about those integrated amenities you mentioned, the pools, gyms, co-working spaces? Are they just nice extras or do they play a financial role for the investor?
Oh, they're definitely revenue drivers, not just perks. Think about it. When a community has its own retail, its own fitness, places to socialize, it stops being just a collection of apartments and becomes more like an ecosystem. And the data backs this up. Communities like this, they tend to have much higher occupancy rates. Leases last longer. And resale values are more stable because tenants don't need to leave the immediate area for basic services. For an investor focused on yield, those metrics go straight to the bottom line.
Okay, that leads us right into the financial side. And this is where it gets interesting, maybe even a bit counterintuitive. You often hear mid-market is safe but boring, returns are modest. This report seems to argue the opposite. What are the financial differentiators making this segment so compelling right now?
Well, one really insightful point is how scale itself reduces risk. Because you're dealing with thousands of units in a project like Reportage Village, you get huge operational efficiencies. Think cheaper maintenance per unit, optimized management costs, and crucially, your tenant base is massively diversified. Losing one or two tenants doesn't blow a hole in your income like it might in a tiny boutique building. Here, the returns are driven by consistently high occupancy and stable yield. It's less about hoping for a quick price jump.
Okay, let's talk numbers then, because if these returns are so stable, what's the actual yield advantage? You hear figures like 7% to 9% being common. That seems, well, significantly higher than luxury often offers, doesn't it?
It does, and that's the disparity Dr. Ghamari really highlights. It kind of challenges common assumptions. Your prime luxury properties, those impressive headline assets, you're often looking at average gross yields somewhere between, say, 4% and 6%. Maybe. But in the well-located, well-managed mid-market segment, strong demand from tenants, plus, importantly, lower purchase prices per unit. That drives yields often into the 7% to 9% range, sometimes even a bit higher initially.
Hold on. So if I can potentially buy into a project that feels safer, more stable, and yields, say, 8%, why would someone plow huge amounts of capital into a luxury tower yielding maybe 5%? What's the trade-off I'm missing here?
That is the fundamental trade-off, and the analysis is pretty clear. Luxury offers the potential emphasis on potential for explosive, sometimes unpredictable, capital appreciation. If that super prime tower suddenly becomes the its building or attracts a wave of ultra-wealthy buyers, maybe your capital doubles quickly. It's speculative. Luxury is often played for capital gains. The mid-market, like Reporters Village, is engineered for wealth preservation and predictable cash flow. It attracts investors who value getting, say, 8% cash yield reliably year after year over the maybe distant, uncertain hope of a 50% capital gain 5 years down the line.
Right. So the mid-market offers a higher floor, maybe a more reliable income stream. Luxury offers a higher ceiling, but it's definitely riskier, less certain. And this predictability, this lower entry point, presumably opens the door to more investors too.
Absolutely. These mid-market projects are crucial entry points. They let global investors, could be institutions, could be individuals buying their first Dubai property, get exposure to the city's growth story without needing the, frankly, massive capital needed for prime luxury. This naturally broadens the pool of potential buyers, which helps liquidity for the whole asset class over time.
Okay, so let's look at the formal assessment of Reportage Village itself. It scored highly, 85 out of 100, classified as a high-yield performer with structural strength. What specific factors gave the analyst that confidence in its safety and reliability?
Well, two scores really jumped out, mainly because they tackle key worries investors always have. The developer delivery record scored 17 out of 20. That signals a strong track record of actually finishing projects on time, which is, a huge relief factor for anyone buying off plan. And maybe even more importantly, the escrow and legal safety scored 14 out of 15. Very high.
And for anyone listening who isn't familiar, what does that legal score actually mean in practical terms?
It basically confirms that the way payments are structured, the way money is held in escrow and released to the developer, it all strictly follows the rules set by RERA, Dubai's real estate regulatory agency. Knowing that your capital is protected by these robust regulatory frameworks, that's a major confidence boost, especially for international buyers.
Yeah, okay. So bringing together those strengths, the high score, the scale, the location, the legal safety, how does this all translate into a reliable income stream for the listener year after year?
It comes back to that ecosystem idea we talked about. The integrated shops, the gym, the shared spaces. It means tenants aren't just renting four walls or kind of buying into a convenient lifestyle. This really boosts tenant retention. People stay longer, less turnover, lower costs for the landlord. Plus, the demand base itself is pretty reliable. These incoming professionals, they're often on multi-year contracts, looking for stability.
Yeah.
That usually translates into stable multi-year leases for investors.
And that connectivity piece being near highways and transport, that must lock in the long-term appeal, right? Even as the city keeps expanding outwards.
Precisely. As long as the area stays well connected to key business hubs, logistics centers, the airport, its appeal for tenants is reinforced for the long haul. That structural connectivity is often what separates a truly successful mid-market location from one that just fills a temporary housing gap.
Right. But we need to be balanced. No investment is without risk. When you prioritize scale and yield like this, what are the, say, three main risks or trade-offs investors really need to factor in?
Yeah, Dr. Ghamari's analysis is clear about the trade-offs. First, you have to consider the potential for yield compression over the longer term. If supply keeps growing very rapidly, it's possible that yield might tighten a bit, especially if construction gets ahead of immediate population absorption in certain periods. Now, the projection towards 5.8 million people suggests demand will likely catch up and sustain things, but it's a factor to watch in the near term.
Okay, yield compression. What about the actual building itself, the physical product?
That's the second point. Build quality variants. Look, these aren't bespoke, handcrafted luxury units. Mid-market developments have to prioritize scale and cost efficiency to hit those price points and yields. So investors should be prepared for, let's say, potential variations in finishing quality. It means doing your homework, maybe being a bit more thorough during handover inspections. It's the tangible trade-off for that lower entry price and higher yield potential.
Makes sense. And the third risk, liquidity.
Exactly. There's typically a liquidity lag, especially early on. Investors going into these projects shouldn't expect to flip them quickly for a huge profit. These aren't short-term speculative plays. To really maximize the resale potential, once the community is fully mature, all the amenities are running, and there's a proven rental track record, you really need to be thinking medium term. 5 years, maybe more.
Okay, that paints a very clear picture. Risks and rewards laid out. So based on that profile, the yield focus, the timeline, the risk factors, who is the ideal investor for this kind of opportunity?
The profile is quite specific, actually. It really appeals strongly to yield-oriented investors. People actively looking for annual cash returns, maybe 7% or higher, with relatively low volatility. It's often perfect for global investors entering Dubai for the first time. The accessibility, the lower capital entry, the clearer risk profile makes it less daunting than jumping straight into ultra-luxury. It's also a great tool for portfolio diversifiers. Someone might have riskier assets, maybe some luxury holdings, and wants to balance that with something generating steady, predictable income. And finally, don't forget residency buyers. The price points for many of these mid-market units often align perfectly with the thresholds for getting property-linked residency visas in the UAE. So it adds another layer of practical benefit beyond just the financial return. So if you just step back for final thoughts or recap the whole analysis, Reportage Village and projects like it are basically a powerful, data-driven illustration that Dubai's next growth phase. It's fundamentally about livability, functionality. It's about creating places that genuinely meet the needs of this rapidly growing, diversifying population.
And that focus, in turn, is what generates sustainable, predictable returns for investors who understand the shift.
It really is the ultimate structural case, isn't it? What Dr. Ghamari's work seems to confirm is that old real estate truth, long-term wealth. It's rarely built on just spectacle and hype. It's built on solid fundamentals, scale, demand, rental performance. Those 7% to 9% yields aren't magic. They're just the sort of predictable math emerging from this demographic wave. So for investors looking for resilient cash flow tied to real population needs, the mid-market isn't secondary anymore. It's becoming a cornerstone asset. And that leads us to the provocative thought we want to leave you with today, building on everything we've discussed. Given that the success of these huge yield-focused mid-market communities hinges entirely on attracting and keeping that global professional segment, the very people needed to hit that 5.8 million population target. What are the next big things, the non-real estate infrastructure elements that Dubai really needs to prioritize to keep those skilled workers happy and ensure they stay? Think beyond just housing. Is it schools, better public transport, green spaces, healthcare, something else entirely? We'll leave that one for you to think about.